Well, inflation is a concept that a lot of people misunderstand. But at the same time, everybody wants to get to know something about it because they seem to think it affects them. So, coming to the point of what is inflation, you can look at inflation in a very simple definition. Is we say how fast the prices are changing. In fact, prices are rising. So it's a percentage of rising prices. Of course, you have millions of different prices. So what you normally do is you put all these prices into one single basket and call it a price index, and you get the price index movements and track it and say, okay, it is inflation. So that's one side of it. The second point of inflation is what it does to you. When you have inflation, if the prices are rising, what it does is very often we are all with limited income capacities. So every time the prices rise, that means the amount of goods that you can buy from that limited amount of money you have will go down. So which we say loss of purchasing power. So very often what people feel is the second one. You find that you can't buy the same amount of goods that you bought just 2 weeks ago. That means inflation has been rising. Inflation has been going at a rate that you can't cope with. So inflation, that is the kind of simplistic point of inflation. But on the other hand, the inflation is a parameter that a lot of people use for different reasons. For example, interest rate. We say interest rate in the market. Now, banks always keep an eye on the inflation because for them inflation matters a lot because they hold cash, and if the inflation is there, the amount of cash, the value of cash is going down. So therefore they have to safeguard themselves against it and also to make a profit on the deposit that you have, and at the same time they lend out. So because of that, you find the inflation is very closely connected with interest rates. So we know that if the inflation is of a higher figure, you would expect quite a possibility of interest rates are going to rise. Then it works the other way around as well as a policy. That is, when the inflation is rising, the authority, the policymakers think something has to be done. So therefore there is a strategy to say counter-inflation strategy, and which is basically to raise interest rates. Now these are fairly complicated areas because the reason is there is no consensus on this particular issue. So coming to a simplicity of inflation, inflation is basically if the inflation is rising at a rate that is not on par with your other income growth, then what it does is your income capacities are going down, the purchasing power is going down, and also it affects the economy across because it makes the relative prices also to change, so that some of the things become too expensive to buy because they are rising much faster, and as a result you find the people's demand for those goods are also changing. Then the third aspect of inflation is that inflation affects different people differently. Very often the poor stratas of people have limited cash in their hand, so inflation affects them far more rigorously than the rich people. So as you can see, inflation affects, so what it means is poor people become poorer. So that's the other. Then the fourth aspect of inflation is something where the prices are moving. It's a moving target. When it is a moving target, suppliers, the producers, when they produce goods, they have to buy raw materials, process it, and then stock it and then sell it. So there's a time gap. Within the time gap, if the inflation is taking place, what happens is they find extremely difficult to price their commodities. So this affects the market system. Fifthly, at a very broad level, if the inflation is taking place, it dislocates some of the basic parameters in an economy: exchange rate, interest rates, economic growth, income distribution. So these are all going to get affected by inflation. Then the question is inflation bad? The point is, you have to have a certain amount of inflation as well. If you don't have inflation, then again it's a problem. That's exactly what is happening in Japan, where prices are going down, a deflation. When there's a deflation, then you find people don't buy goods because they wait for prices to go down further. So it's an entirely different scenario. So inflation is a bad thing which you can't be without, but having too much is too much of a problem. The inflation can be short-term inflation, is where prices are just fluctuation happening due to simple demand and supply, so seasonal matters. Because take our inflation, for example, we have about 60% weight has been given to food. So if the food prices are going up, so will the inflation. But on the other hand, inflation is caused by, as a trend, could be there are a number of theoretical positions. One says if the wages are increased, so will the inflation, because that's causing prices to go up. Or some argue that if there's budget deficit, there is inflation. Some argue that if there is excessive money printing, there is inflation. Some argue that if the exchange rate depreciates rapidly, there is inflation. And also there are arguments to say that we import a lot of commodities. If the commodity prices are going up in the global system, take for example oil prices going up. So oil prices basically cuts across all the prices: energy, consumption, production. So basically oil prices not only causing direct impact on prices and inflation, because it's a consumable commodity, at the same time it's an input to so many other commodities, so which will create a further spiral of inflation. So the inflation can be caused by so many different things theoretically and to some extent practically. But some of these theoretical positions seem to have lost its credibility. So this is where we are now. So the debate, sometimes people get agitated, just something is happening, then people say, oh my God, there is inflation. But if you look at the data, sometimes these things really don't tally up. Right, money printing is, actually there is nothing called money printing. It's a misnomer, it's a misdirected explanation. What happens is, money is printed by the government. These monies are printed and stored, literally if you say, in the central bank's basement. So the money notes are there. But at the same time, there is quite an amount of money in circulation, because money is being released to the economy through the banks, either to replace damaged notes, and also to accommodate transactions are going up, economic activity is rising. So you have this natural money being injected into the system. But people don't call it money printing. Money printing comes, the government has an annual budget. So they have the expenditure and also they have the revenues. Now what happens is, when the government falls short of its revenues, you have what we call a deficit situation. In a deficit situation, the government can borrow money from public, government can borrow money from commercial banks, or government can borrow money from central bank. Now each one has its own implications. The money printing in precise sense is that when the government borrows from the central bank. So here again, government is not getting an open check from the central bank. So it is government borrows money from the central bank, so central bank is the lender. But the difference here is that cash comes from the basement. So the money that had not been in circulation, that had not been used by anyone, is an additional quantum of money coming into circulation. So this is called money printing. Why it is called money printing is, people have given a specific impact due to so-called money borrowing from the central bank, because theoretically there is a theory to say that this money expansion through this kind of thing is bad for the economy. So, but that thinking has been busted by many other counter economists, but more so by the government themselves, because the governments have been borrowing or printing money at a rate, and the most classic examples of printing money is the COVID situation, where everybody has been on the printing press literally for a large chunks of money. So the money printing is basically not printing money, borrowing from the central bank, which in a way saying you are creating additional cash into the system. What happens is, as I told you, there are three avenues of deficit financing. Now, governments try to look at other avenues, not so much the printing of money, partly because of the fact that it has such a lot of bad publicity, politically sensitive. But nevertheless, governments do resort to this money printing or borrowing money from the central bank for 2 or 3 reasons. One is, now as you refer to the newspaper item to say that the largest chunk of money being printed by central bank on such a date. Now this doesn't make sense. Just because a particular day it happened doesn't make sense. But what happens is, over cumulatively how the money has been borrowed by the central bank, from the central bank. But at the same time, government borrows when the expenditures are due to be settled. So when you have large expenses arising for number of reasons, so these situations you have to honor those bills because government can't default. So government borrows money. Whether it has any other implications is a different thing. So it's simply on a need basis. Government just does not just take money for this because the central bank will give you the money. So that doesn't happen. There's a second reason why the government borrows from the central bank is there's an alternative. Government can go to the money markets and borrow. Government, not like any other individual, is the largest demander of cash. So because of the size of the government borrowing, it basically disturbs the money market systems. Now in the present government setup, they are trying to hold a low interest rate policy. Now what is interest rate? Interest rate is the price of money, market price of money. If there is more demand for money, the interest rates are supposed to go up. If there is a more supply of money, interest rates are supposed to go down. Now here what you are trying to do is, you are trying to maintain the interest rates at a low level. Why? It is important to keep the economic growth machine going. So you have given it as a policy, look, we are going to keep the interest rates at this level for the next 5 years. So therefore, they have to be very careful in coming to the money markets and borrowing. So because of that, the governments may resort to borrow from the central bank to meet their expenses. Secondly, there are so much of expenses coming up, especially under the COVID situation, which are fairly large unplanned expenses. So that again is a situation where in a money market you can't just walk in as you like to meet up these expenses. So it is going to disturb the money markets again beyond the demand aspect of it. So therefore that's another reason you would find another valve of getting this money across to the system. So the money printing comes in that as well. Third point is, despite the fact that there is a lot of counter arguments about money printing and inflation and so on and so forth. These issues have not been a primary focus of any government now, because it has not shown the kind of theoretical positions that have been taken up. So as a result, the money printing is taking place without a serious problem being posed as a result of that. So this is how the money printing comes into the discussion of government expenditure funding in the modern current context. It's not the printing of money and inflation, it is the stock of money. So what they say, it's in the excess stock of money, because there is a supposed demand for money, there's a supply of money. The argument is, when you have excess money chasing behind a limited stock of goods, the only thing could happen is the money value of the good is going to go up, so which is we call inflation. Now this particular theory, when we teach in classrooms, we take a very simple example, overly simplified example. The example is, in this class there are 100 students. Imagine each one is given 1,000 rupees by the lecturer, and then if there are certain commodities which are on the table where they can bid for, if before 1,000 rupees, they will bid for them at a certain price, but after money it's going to bid for at much higher price. So the only thing, the difference was the money has been given to individuals, and which basically caused them to bid for higher price. But in an economy, this is not how it works. Economy is an organic situation where it changes all the time, and it interacts with each other back and forth. When there are money, people buy goods, and when people buy goods, then the goods are being produced. So there's a whole chain of reaction, and the economy is a circular flow. So circular flow is, there's no starting point, there's no end point, it keeps on going, each one is affecting each other. If you take that into account, what you see is money, if the money is actually, I need to make a point here. When you say government borrowing money, government is not going to borrow money and go to some building, to the topmost building, and throw the money across for people to pick up. That's not what happens. What happens is government is paying for services. So that means there is somebody who's getting paid for a service, so which accounts as an economic activity. And then once it is get paid, then that money is being used to buy so many other things. So there's a whole chain of reaction that can take place with the money being introduced. So what it does tell us is it triggers a whole chain of activities. So that means once the money gets into the system for certain activity, it creates a whole chain of different products and goods and services. So which means now there will be more goods and services coming into the market, and more goods and services coming into the market, and at the same time, since the government has spent money on various things, there are more people who have the capacity to buy those goods. So now you have put a matching couple. One is one with cash in demand, there is another one with goods and services who are producing. Where the chain can break is if the goods and services could not keep up with the money, and then what happens is there can be a pressure on the prices. Now, point here is it can happen if you have ruptured the whole circular system due to so many different things. So it is not totally guaranteed that money is not going to create inflation. Under the certain circumstances it could happen, but there's always a potential that the economy can pick up and economic activities can pick up, and so that the money eventually translates into goods and services, and more goods and services and more activity and more money is demanded. So it goes on and on. This scenario has been argued and empirically tested. Unfortunately, in the economic elite discussions, there are certain amount of people who argue ideologically that it is true. So they want to go about proving that come what may. Then there is another set of people who are looking at more pragmatically, look, don't get yourself boxed into this. This is a flexible arm that the government has, but not to be overused. But whenever the situations come, it should be allowed. And also they argue that this is the possibility. So once the government does this, government has a responsibility to make sure that this flow is going unhindered. If they just do it and keep on doing it excessively, disregarding the transmission mechanism, then the rupture is going to take place and the whole issue is going to be getting out of disproportionately exploded. So there is no particular guaranteed situation for anyone. Now let's go back to some of the real studies on inflation and money printing in countries where it has been excessively printed, disregarding all the norms and ethics, and that has caused now the studies have shown the exact opposite. Money printing has gone through the roof, but inflation has failed to pick up. So theoretically, the situation has been challenged once again on the empirical basis, because it doesn't seem to be holding the kind of strength and the ground that people preach, as money printing and inflation are very closely related. When you say, as we explained, money printing is you're introducing money into the system. So that means the more cash is getting into the hands of people. Now what happens as a result is that when people have cash, there is a normal tendency for consumption. So people go for a lot of consumption commodities. But at the same time, if you have a situation where there are a lot of goods that are imported, are available in the market, people begin to purchase these goods as well. So then what happens is, with the money circulation, with money in the hands of people, if the production is not taking place within the country, that production boost gets injected to some other country because of our import bias in the system. So if you print money, one way of getting the money into price escalation is people begin to buy a lot of imports. So you find the imports are going to be more and more as a result. And then it affects two ways. One is your imports and exports difference going in the direction of imports. So that means you're going to face a more inflated, bloated trade balance situation, and hence the current account situation. The second problem is that when the imports are there and more imports coming in, there's a pressure on the currency because more currencies are demanded to import goods. Once that happens, then the inevitable outcome of that is either you have to supplement that with more dollars being injected into the system, which will keep the currency in a certain level, or you let the imports to take the whatever the currencies in the market, thereby putting more pressure on the currency, and that creates the exchange rate to go adversely, which, putting in another way, the local currency begins to depreciate fairly rapidly. Now this we saw in the last government regime, where they had a system of they introduced a lot of cash into the system because they inflated expenditure, and also they at the same time they had a very flexible free trade regime. So that means imports were not considered as under any restriction. So what happened was, this took the balance of payment into the negative territory more and more, while at the same time putting more pressure on the exchange rate. So as a result, as you could see here, printing money can permeate through inflation channel unless this inflation channel is blocked to a certain extent. So in the present context, the chances, most of the luxury consumer commodities, especially things like cars and other stuff, are restricted. So the channel has been blocked to a very large extent. So therefore the printing money does not find the same pathway to pressure on the exchange rate and pressure on the balance of payment. However, it does not mean it is totally immune from that system either. There is some pressure, but that is a kind of a status quo that we all have to face under normal circumstances, or maybe slightly over the average baseline situation.